Good morning. Welcome to the show today, Traders Workshop. I'm going to warn you, there's a disclaimer today. Put your seatbelts on. This is going to be a tough one. The reason I say that is heavy mathematics, and we're going to scare each other today. So hang on to it. We're going to try to explain this intuitively. And it's all about interpolated implied volatility between 2 months, especially when we look at earnings. We'll talk about it after the bell. That I don't have. We'll get it one day.
Yeah, we put an order in.
You did?
Yeah.
Hi, boys. How are you? Good to see you. Happy Thursday. 2 days before the big weekend. My favorite big weekends. Okay, let's get right to it.
I'm excited for some math. I'm really excited for the math.
Yeah, I know. And Jason's the real math guy, I think, by training.
We've looked into this all the time. I may have some points in the middle.
Okay. So let me lay it up. I'm going to turn it over to Mark and Jason, and then I'm going to chime in here and there. Okay. So here's the deal. When you look at earnings situations, typical stock, call it Tesla, call it Apple, fill in the blank. In the earnings month, that closest month that incorporates the earnings, you're going to have higher implied volatility because there's going to be some sort of news announcement and a binomial sort of event or binary sort of event that's going to go up big or up small or down big or up big, as the case may be. So they price that in implied volatility wise to cover that. Months after that, they tail down in implied volatility. So you have a big discrepancy between month one and let's say month two, and then months going up. But we're going to talk about month one and month two. Huge volatility discrepancy. So the problem we have before us is to interpolate the effective implied volatility of a calendar spread. It can be a diagonal with different strikes, but let's just talk about a calendar spread today. Same strikes, different months. One has the implied volatility, implied volatility, earnings implied that we're selling, and we're going to be buying the second month. The question is, what effective implied volatility do we own by using those two values? Okay. Does that kind of sum it up, Mark and Jason? Chime in, add, delete. What do you think?
You're long some vol. You're long some vol in between those two numbers.
100%. And I will tell you, mathematically, it is not the sum of the two implied volatilities divided by 2. Okay. That is not the answer. It is some other number that is a variance model and, the square root of time and yada, 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 which we're going to try to talk about. We're going to try to do the 101 version. Good luck.
So maybe we should talk about why do we care about this in the first place?
Yeah.
Are we just doing math for fun, or like why does someone actually care about this number in the first place?
Okay. Tia, I've got an answer to that, but I'm going to let you go. So I've been talking too much. So go ahead.
So like in the earnings situation, I think you care about it because like we've been talking about with these earnings trades, like you look at that and you say, I'm selling 140 vol and I'm buying 70 vol. Like, great. I have a big fat, spread. Earnings are going to get crushed. And, one of the things we've said before about this is like, you're putting on a long Vega trade. Like you have that back month Vega and you have that, you're actually kind of long vol in this sense. But like, what is that number? Like, how much vol are you actually long in this whole thing? Mm-hmm. And like, where are you buying? What kind of movement are you buying with this whole spread? So like, from an earnings trading structure, I think it matters to understand that point about, setting up your trade and what you're doing on that trade.
Right. Because and again, from just the empirical side of it, you technically don't want to be buying too high of a implied volatility net in the spread, right? Because we know what's going to happen. They're both going to get hit. Both months are going to get hit. But if you're buying something that's effectively an implied volatility that's near, 30-day historical implied volatility, it might be a good spread to do that. right? You're not going to get hurt so bad potentially on when maybe the good event doesn't happen for you, right? You have some protection. So anyway, great. Jason, you want to toss in anything here? Are you good so far?
No, I'm good. Just waiting for the math.
Wait. Oh, the math guy's waiting for the math. All right. Okay. So Mark, how do you want to go from here? Should we go to the math or is that scary? This is like looking at a crime scene, I'm going to say right now.
we can flash some math there, but I actually have another use case for like interpolating between these volatilities. And like the earnings case is interesting, obviously, because, at the end of the day, implied volatilities are implied by the market because we have expirations, because we have listings. Right. We don't have listings for every second or every minute of the day. Thank goodness. Like even dailies get to be a lot in the SPX, but those only describe the implied volatility between now and that expiration. That's why we see the wonkiness in earnings, because we know there's going to be a concentrated bit of this implied volatility in that short time. It's not representative of like the long-term 30, even 360 day implied volatility.
Right.
But even outside earnings, you only have fixed expirations. So there are other interesting vol interpolation, vol adjustment use cases where you might want to be looking at, say, a constant number over time. Mm-hmm. Instead of just the nearest expiration that's going to have its own quirks to, how many days it is, whether it's 28 days or 34 days or whatnot. If you always want a 30-day figure for some kind of indicator, some kind of like, reading of the market, that's another useful, kind of, or another good use case for interpolation.
Sure. So, okay. Typically with interpolating, implied volatilities between months, it has a time function. Not typically, always. It has a time function, right? And time function in our business is a square function or a square root function, right? Either of you want to tackle the reason why there, or we just leave it as is and say the mathematicians figured that out for us and just believe it? Any thoughts? And again, I'm not trying to put you on the spot. I'm not sure I could explain the square root part of this, but I know that it has to be. So, okay, we're all looking like someone just farted at the Christmas party. We're looking at each other trying to figure out who did it, right?
I think I'm going to get us in trouble if I start going down the linear or the square function of time rabbit hole.
Okay, let's not then. All right, let's get to it. Let's do some math. You ready?
Ready.
Okay.
You said you wanted to use the remarkable. Here we go, Lex. Let's see the remarkable.
Let's go to the remarkable. All right, here we go. I think. Here we go. Oh, good God, Jason. I hope your math brain's on. So this is an effective IV weight. This is one formula. Okay. Now Mark has a slightly different one. There's even another one that's called the interpolation formula, right? So all this is it's very simple, actually. So we need to come up with what IV1 is. That's the near, in our case, it's the nearer term. Okay. We need to come up with IV2. That's the second term. Okay. We need to know days. However, in the formula, days is computed in what part of a year is it? So the typical metric in our business has always been divided by 252. Some people would say it's 365. I always use 252, and that's the number of trading days in a year. Okay, because there's holidays and weekends and such. So I use 365 here, but I think it's more accurate to use 252. Nevertheless, if you have 5 days to go, it's just 5 divided by either 252 or 365. That's this value. Okay, and then for T2, that was 10 days. It's just 10 divided by 365 or 10 divided by 252, whichever you prefer. Now you got to stick all.
It doesn't matter as long as you're consistent, right? Because like you could even drop the divide by 365 because you're converting either way. So as long as you're consistent, it doesn't matter.
Right. So what we're doing is we're getting the how would you call it, Mark? The variance function of time frame IV1, variance function of time frame IV2.
I think like the variance. I want to double click on that because like that's like the high level important like point about getting into the math, like is that when you're comparing IVs, you can't compare the implied volatility as read, on your trading terminal that, the SPY is implying 22% IV.
Right.
You need to compare variances because variances are additive. Variances you can work quote unquote with variances and apply arithmetic to variances. You can't do that necessarily with volatilities as like this annualized figure. So this part about converting to variances, whether it's to come up with an effective IV, an interpolated IV, like do the math on the square.
Right. 100%. 100%. And then we're dividing by the square root of T2. Okay. Because we've taken care of T1 minus or T2 minus T1 up in the numerator above, right? Which is this function here. Now, you folks are going to be looking at us going, what in the world are these people talking about? Right? Who's going to do this? Well, my answer to that is no one. But what I've decided to do in Tradier Pro is I'm going to add this calculation to the ticket so that when you do a mixed month spread, it's going to spit this number out for you. Now, my analogy here is that it's nice to know how the red light, the stop light works, all the funky stuff behind it, but whoopee-doo, just know what green, yellow, and red means when you're driving your car, and you know what to do with the brake and the gas relative to that. That's all this stuff is, right? Jason, please go ahead.
All right. What are you using as a reference point for your IVs? Because these IVs, are you basing them off of the market pricing?
Yes.
Because you guys are talking about interpolation, which means it's not based on market pricing.
Well, I want to know if I'm selling a 140 vol or in this case, a 75 vol in the front month, and I use it 0.75. So it's really 75 vol. We talk about it. If I'm selling a 0.75 vol in the front month and I'm buying a 0.50 vol in the second month, what is my effective interpolated implied volatility with this term structure? Okay. And I didn't do the math yet, but I'm looking at it, because the show started. But it's somewhere in between those two values. And if you get a big enough bump in month 1 versus month 2, you might be able to actually effectively purchase volatility that's even lower than part 2, than 50 in this example. In this, I can tell you intuitively, the difference between 0.75 and 0.50 over 5 days in this example is not going to be less than 0.50. It's going to be closer to 0.75 is probably, right?
Yeah.
The weights get really funky. It's really not intuitive, especially at the low DTE end of the spectrum. When you have really high vol, like squared against like a short DTE versus whatever that other expiration is, it's worth doing this math just to prove that to yourself.
Right.
So in shorthand, how would I determine how much IV am I exposed to if I put on earnings on this? Put an earnings double calendar.
I'm sorry, I missed the first part of that. I apologize.
So like, is there any kind of shorthand I can use to determine how much Vega I'm exposed to? Because really both of these, while we're, this is the standard for like a calendar, but both of these implied volatilities have like abnormal volatility in there because of the earnings. So we have to figure out if my back month is worth buying, I guess.
Right. Yep. Exactly right. So this formula will essentially give you what your effective volatility that you're purchasing is. Okay.
Right, but but IV1 and IV2 are going to change even in relation to each other.
Correct.
After earnings. So the formula would give you if they were both completely measured.
That's right. And then what will happen though is that let's say you're buying in this example, I'm making this up, 670 volatility, which is closer to the front than it is to the back that you're actually purchasing. So the effective vol is 70. Well, if you know that implied vols will traditionally go down to 60, it's probably not the best trade to make right here after earnings, right?
Right.
Because 60 to 60 going down to 40 or whatever I said, you're going to lose 20 volatility points, irrespective of the difference here. Now, if your effective vol is a 40, and it goes back to 40, you have two things working for you. You're probably not going to lose a lot on the effective spread and vol recomputing after earnings. And you have the added probability of the spread going to a very advantageous spot, meaning the short strikes of either side if you're doing double calendars. So two things could happen. You could hit the level on expected move, and your implied volatility you're effectively purchasing is way lower than you think. Right. So that's the number that I think for the retail folks who are watching, and I know this is confusing. We're going to try to make this as easy as possible in Tradier Pro. And Jason, I'm sure you can do it. Mark, you can do it on your platforms. But we want to make it so it's a simple number. You do these things, then you have it. We already know implied volatility, and you build the spread. We're going to show you effective volatility that you're purchasing or selling if you're selling the second one, right? You have to know which Vega you're doing. And then once you have that, you should be able to say, good trade, bad trade. I'm out. I don't want to do this earnings play. It's not good enough yet. See what I mean? Now, there's
I agree.
Yeah. Okay.
I don't. I don't agree.
Go, Mark.
I think the implied volatility is super interesting. It's important to understand from like a spread perspective.
Yep.
But I think what you said about, and what Jason actually said pre-show, is that it's the realized vol that matters. What matters on an earning play is whether it goes to your short strikes or not.
That's true.
Implied volatility doesn't matter when you're putting on.
No, and let me clarify.
That is a far secondary factor.
Yeah.
It matters where it goes, especially with such short-dated earning structures.
100%. That's a great point. Let me clarify what I said and what I mean.
Yeah.
If you do not get that move, that is the most important part of the equation toward your short strikes. This can soften the blow, as it were, if you're buying an effective vol that is near where this is going to revalue at the end of the day. That's all I'm trying. You're still going to lose.
I agree.
You're still going to lose, but you're going to hopefully lose a soft landing as opposed to just get utterly creamed. You don't do the utterly cream part. If I'm buying an effective 75, it's going to 50. I ain't doing it. I'm not doing that spread, right?
Yeah, I think, that's what I thought Lex was saying, is that we need to know when he puts on his double calendars, which is the Lex special for earnings, he needs to know if that's a good trade or not. And the implied vol, realized vol after the trade, yes, but the implied vol before, he has to determine whether whether he's going to get vol crushed because event vol declines. So he has to know whether the long Vega trade is the right one, or if he has to go short Vega, like a butterfly or something, butterfly.
Yep, exactly right.
I think what I'm trying to say is that like vol and Greeks and Vega matter on positions that are Greek rich. Like, I don't think that like your realized P&L on an earnings position is not a function of Vega P&L. It's a function of like underlies vol like gamma P&L, like
it's also
like it's the reason you talk about straddles versus implied volatility. Like, are you talking about like a 2-day straddle? Like implied vol is like it's not Vega, it's where stock lands on those two coin flips.
I think that's right, and that's a good point for folks to understand, is that the only reason I do these spreads is because of the movement. That's I shouldn't say the only reason. That's the main reason. The second reason is I don't want to pay too much for this interpolated vol, okay, in case I don't get the movement, which happened to me in Amazon last week. Amazon did not move toward its expected movement calculation, and I lost as a result because I probably had too much interpolated vol and I didn't get the move. Now, did I lose because of the interpolated vol was too high that I purchased, or that I didn't get the move? Probably I didn't get the move.
I would say it's both, because I was looking at
part of the move. But yes, you're right.
And the move got down. Amazon got down to 228, and the expected move was 225. So
I think I was on the 217 line, but yeah, okay, whatever.
Yeah, but still, I was looking at 225, but like that was the expected move. We got really close, and it still lost money. Like,
yeah.
Even though it was right there.
You're right, for sure. It definitely did. Okay, what else can we take away here? Anything?
So how do market makers determine this IV in the first place?
Mark, I'll let you tackle that one first.
By the number of buyers and sellers that come into the marketplace demanding or not looking for vol?
Well, then then you're assuming that it would be a smooth buyer and seller if the skew cube is smooth, right?
You do see some interesting things in terms of order flow around earnings that especially in like the most liquid names, there used to be like a funny little W that would show up, like where people are biased to like selling the earnings, or customers are biased to selling the earnings. But I think when you come up with like the time that you have to come up with an earnings vol tends to be with like a new month that gets listed, right? Like when all of a sudden the weekly or monthly that like has Apple earnings like gets listed. And like probably the back of the envelope way I think a lot of people said it is in context of what the current vol environment is and like what historically that has done moving.
That's really, that's the answer I was looking for. Mostly they price these earnings because of the historical movements of the stock, right? Mostly realized vol of the other earnings, including, and then adding in the amount of time, like the regular vol too, right? Like that. Is that accurate?
That's how, like, if you have to start from zero, how you would price an earnings thing. But like your size on that price is like 10 up. Like, right, you let the order flow dictate what the price of earnings is after that.
But it's smooth, right? You have like the at the money is like your standard, but then it's smooth, like your skew curve and your implied volatility is skewed, right? I'm sorry, smooth. It's interpolated.
Right.
So it's a smooth surface, right?
Well,
like, and we see that, right? IV is like, there's a smile, but there's no like knots of like 17, 12, 15, 18.
Oh, you should, yeah. It's consistently curved. It's not technically linear, I guess, right? It's more curved.
Yeah, well, it's smiled. But my point is that is the option traffic that you're saying, is that smooth? And it
is your question more like how do you determine the skew of earnings? Like what I said is more like a at the money vol kind of thing. Or
at the money vol, yes. And then they use that at the money. I mean, this is from academic papers and stuff like that I've read. They use that at the money as like a reference point based on mostly supply and demand, and they interpolate it across. But I mean, I wrote in my Twitter post that you had some splining to do because that's where I thought you were going to go. But that's what it's called, right? Bicubic splining, where they smooth the surface based on a reference point, like the at the money bid and ask, right?
Yeah, so like there are implied volatility models like Sabre, for example, that take like three parameters and create a smooth surface. And then like you can get more advanced with like no arbitrage models and whatever, but like it's all coming down to like parameters of a curve.
Right.
And that like there are both relationships, like in a non-earnings context, there are relationships of those parameters across time and how you'd expect that like consistent surface to look that, theoretically would, you can apply those same parameters to, listings in between, new listings, whatever, extrapolate them, all that. Like there would also be like event type parameters that you can say like, oh, the spline on eventiness starts to look like this. So like, it's all,
Yep. Agreed.
But most of that is like when something comes, like when something's new. Like at the end of the day, like a market maker's not taking a position that like says this is out of like, line with what my models say earnings are. They just lower their bids.
Right.
Like,
so, but my point is that the skew curve is always smoothed, right? There's you never see like zigzags in the skew curve as it's going out of the money, right? Because I think
earnings are where you do actually that like if there's like almost like too much of a one-sided position, then like you can see kinks from not wanting to buy above or below a certain level, like from a no mas standpoint.
I mean, I would need to see that, but my point is that it is not in accordance with the actual open interest, right? It's not in accordance with the act because open interest, let's say on SPX or something coming up on FOMC day or something, it's heavily weighted on the zeros, 25s, 50s, 75s. And in between there, it's not a smooth curve between those strikes in OI or in traffic and option traffic. But the IV curve is smooth.
Did you say the IV curve is smooth?
Yeah. And like I'm not talking about SPX and apples of the world, right? Like I'm talking about tier Ds and Fs where like position.
Oh, yeah. The little ones, yeah. But my point is that if they were, and those spots through Gamma, Vanna, Charm, whatever, those areas are would create more or less delta hedging as market moves in those directions, or implied volatility goes up and down in those directions. But is that accurate to say?
I don't know if I really understand the question.
No, like if the market moves or implied volatilities move, because the orders are not, because the open contracts are not smoothed, just like the skew curve is smoothed, you would have differences. The acceleration of buying or selling the underlying would be different based on those based on the non-smooth orders, like open contracts, based on the non-smoothed book.
I think you're getting smoothed over. Just so we're clear.
Yeah, my brain maybe is too smooth to understand this.
My point is
let me.
I think they're two separate things.
Okay, I got a couple questions, and then let me bring up another concept. This is Mark's concept. Okay. Before we go to the questions, the concept is interpolated IV along the curve. So you got T1 1 day. Again, I'm making this up. T2 10 days. Interpolated vol of, let's say, T5, right? And Mark, this is what we talked about pre-show. How do you get that interpolated vol along the path of T1 to T2, right? So there is another computation where you take the rate of change of implied volatility as a I guess a variance function, I would imagine, and then you add that value to the starting vol, right? And that whole complex is multiplied by T minus T1, whatever T is where you want to go, right? Which is kind of goofy. So what it looks like, let's go back to the screen real quick. And again, we're going to run out of time here. We're going to have to pick this up next time. So what I'm trying to explain, DT 1 day up here, okay? We have 9 days to the second expiration. That's our spread, a 1 and a 9 day. And I said, what is the interpolated vol at 5 days on this? Right. And the way that works is it's this formula right here. Okay. So what we're doing in the middle with IV2 minus IV1 right here divided by T2 is that's a rate of change. IV1 is where we're starting at 0.75 in our example. Well, what's the rate of change? It's probably going to be a negative number in this example because it's coming down as time goes on. And we want to know where we are at, and you're multiplying that by your T minus T1, and T is what day you're looking to compute your interpolated vol at in between that structure. So Mark, I know you have a formula that's probably a little different, but theoretically same concept in our heads.
For sure. And I mean, I think this is just like another example of like how to like work with volatilities. Like, like when you're trying to come up with something that like isn't necessarily listed or understand, what the implied vol of a spread is, you have to do some arithmetic on them. So
yep,
the formula to interpolate is the same way you linearly interpolate anything.
Sure.
You just have to do, the important part is doing it with variance with
yep, exactly. That's a good point. Let's stop there. Okay, let's go to I'm gonna show a question here real quick, if you don't mind. I think I'm gonna show a question. I'm hitting the wrong buttons. Thanks, Luis. Okay.
Arranging us.
Yeah. All right. Any thoughts on this one from Doug?
I think this was when we were talking about the earnings trade that we saw this, that we were talking about like how you're in your calendar, you're long Vega because there's, the further dated option has more Vega. Yeah. So that is, Doug, that is correct. That's what we're talking about. So typically we do the question is, the longer term option has more Vega than the shorter term option, which is absolutely correct. So you are purchasing Vega in this equation. Okay. But you're not necessarily purchasing the Vega that most machines are going to show you. It's some other value, okay? And in our trading days, when we had our trading firm, we had a value that we computed mathematically with all these fancy formulas that we called adjusted Vega in our inventory, and it was weighted, okay? So that's what we're essentially trying to get to in layman's terms, is what is your weighted Vega sort of, okay, with purchasing one of these spreads, okay? And Mark is a strong believer, and I think I am too, Jason. I'm not sure where you fall here, but we're a strong believer in doing these spreads. You are more critically focused on movement of the underlying than you are on the Vega that you are purchasing. Both can hurt. One's going to hurt more than the other, but
if you can soften the blow of buying a reasonably good volatility relative to the difference in the volatilities of the spread, maybe in a bad move situation where you don't get what you hope for in the underlying, you can soften the blow or even break even for that matter. And that happened to me. Shoot, what was it? It might have been Tesla. I can't remember. I had such a big spread that the differences were massive, and I computed what it was, and it was way down by 30-day implied. Not that's probably more like 20-day. So I didn't get the move I wanted, but I got out of the spread for a small profit, which was great. So I kind of scratched it to made a little bit of money as a result. So the value of the spread that I had was a good one. Relative, and a move I didn't get. If I got the move on top of it, I hit a home run, but I didn't get the move. So
yeah, you're trading the move, but implied volatility can determine your P&L, that implied volatility difference. So when you're doing the and I don't know, like Lex, when you put on these calendars, are you doing this?
I am doing this. So I do look at it, and look at my saying, I just like to get close. With these things, it's not for me. It's not an exact science. If you tell me that I'm buying a 62 vol and it's really computed to a 60, I don't give a rat's. You know what?
Right.
Close enough. Okay. So I just want to be in the ballpark. I don't want to be buying a 80 volatility when it's really, when it's really should be a 60. Right.
Yeah.
I think I'm buying a 62 and it's really an 80. That's what I want to know.
Yeah,
I just want to know. I just want to see the yellow light, so I know whether to hit the gas or hit the brakes. That's it.
Yeah. So I think you're right. It's the move that you're trading.
Correct.
But implied this calculation makes it whether this is a better trade or going short Vega, like with a butterfly, is a better trade.
Yep. So yeah, and for the viewers, if you have an opinion on this, we'd love to hear about it. Again, you don't have to put it in now. Send me an email for if that's easier. It's lex@tradier.com. I'd love to hear from you. I know I spoke to one of the viewers last week who's asked a few questions today as well. So I'm happy to do that sort of thing. I meet with folks all the time on a Zoom. We can arrange a get together with some of you, or even a single person if you want. But we love feedback, and we really want to know, if where your interest lies. I know this is really heady. This is really beyond what you need to know. You don't have to know this formula. If we can give it to you and you can interpret how to use it, good enough. End of story. Unless you're a math geek like all of us tend to be, you want to know the derivation, wonderful. We can give you that too, but know how to use this stuff. It's super important. Okay, hang on. I'm going to show another one. So question from Johannes is, have you looked at correlation between the dealer book and realized IV? So is there a possibility to just skew according to the dealer book and maybe get cheap vol or high vol expensive IV? Does that make sense, Jason?
Yes. So, I mean, it's kind of what I was getting at before a little bit, where the deltas, like the imbalance of the deltas is traded in the underlying of these stocks, like, Amazon or whatever. And the dealer book is, as we have it charted out, the dealer book is showing where those deltas would be more intense, from one way or another. And that implicitly, since it's being hedged with the underlying, it impacts IV. Yep. Because if you have a ton of deltas to sell, then you have to, or, you have a ton of you have to sell a lot. That will move the underlying, right? That's basically how you're defining the volatility. Mm-hmm. So, if there are spikes, my point is that before that I was making is interpolation, and the way these are priced, it smooths out the curve and makes it kind of, it's bumpy, but it's not like, and not talking about illiquid places, but, in liquid stocks and indices and highly traded stuff, there's very few major bumps that would indicate that there would be higher IV due to delta hedging in this area. Mm-hmm. And that's the point I was getting at, which is, this is why vol to us is important. Mm-hmm. But, and I didn't know, I realize now I missed, the point of the show, which was to determine whether these calendars are good priced. But
Yep.
yeah, that question was kind of getting at what I was getting at in this thing. But yeah, go ahead.
Yeah, no, let's answer Doug's question again.
Yes.
Realized volatility isn't an option metric. It's based on the stock move, not the option prices. That's
And
correct.
it's backward looking.
Yeah, and it's also backward looking. So
Mhm.
that's a good point, Doug. So what we like to know, so the great thing about options is that implied volatility is forward looking. That's what we expect the market to do in the future.
Mhm.
Realize is backwards looking. That's what we've seen it do in the past, right? So we can certainly use both of those together to come up with a reasonable assumption of what you should be positioning yourself like with buying and selling options. Right now, is there a guarantee? Hell no. Just like you can get a snowstorm in the middle of August somewhere, but not very likely, but you can have it happen. So yeah, anything can happen on those things, but again, you're constantly trying to put some sort of statistical favor in your bootstrap, in your kitty, so that your probability is such that you're on the winning side, right? I want to be the house. That's
and also realized vol.
do.
Realized vol is one of the primary inputs into determining, pricing for implied vol.
Right. We're all dumbfounded. We're not talking anymore.
Yeah, I don't know. I have a lot of thoughts on this. I definitely agree with Doug here. I think like at the end of the day, like I don't know what the purpose of trying to beat the dealers at the dealers game are. Like they're playing, like the way they're pricing skew is a model. Like yes, the order book is, or the open interest is a manifestation of where like buyers and sellers come, and like the implied volatility pricing is how that's converted into a model and like theoretical distributions. And so like the impact of like sliding along a skew curve versus order book or versus open interest, I think are uncorrelated, items. And I don't.
But should they be?
Yes, that's an efficient market.
Right, they should be, but they're not. And that's the inefficiency that I'm talking about. But anyway.
I agree to disagree on that. I do not think there's alpha there.
All right, boys. Let's let this one marinate. This is like the steak I'm going to eat tonight. It's in some soup right now, marinating. So we gotta let this sink in for everybody. I know this was really, really a tough one. We get it. Takeaway, in my opinion, is nice to have this formula. Probably not massively heroic. I like to know what vol I'm purchasing on these earnings plays, so I know whether it's a good spread or not. But Mark's point is excellent. I'm looking for a move. I can tell you that 100%. That's what I'm looking for, and that's what expected value helps me with. So, coolio.
Cool.
All right, guys.
Happy trading.
Happy trading, everyone. Thank you. Bye now.
Bye.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.